Hi, everyone. As you are filtering in here, I'll do a quick introduction for myself. Hopefully, a lot of you guys were here yesterday for part 1 of 7 Pillars. We're excited to have you back. We hope that you join us for our other webinars that are upcoming. We even have one on this Friday. Few housekeeping things before we get started. Same as yesterday. If you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. The first thing that we're going to need you to do is fill out our poll questions as they pop up on your screen, and then also fill out the survey at the end of this webinar. There will be a couple ways you can do that. It will pop up on your screen. You can fill it out then, or if you missed that for some reason, pop-ups are blocked, don't worry about it. It will be emailed to you in 24 hours, and your CPE certificate will be delivered to you within 48 hours of filling out that survey. So if you're wondering where your CPE credit is from yesterday, it should go out to you sometime today or tomorrow morning. A couple other important things to take note of. If you have questions as we are going along, please ask them. We really encourage you to not keep those in. Ask them as we go along. Use the Q&A in the middle of your screen, and we will either get to them at the end of this webinar or follow up with you via email. We will also be sending out the slides once we get the ball rolling a little bit on this webinar as well. You can look for those in the chat box. That's where you'll find the handouts from today's webinar as well. So I'm going to do a quick introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really wonderful team here who are dedicated to fulfilling your state tax or related needs. So we do a lot of returns, registrations, consulting, research, like our name states, more. So if you have questions about our services, please reach out and ask us. We'd love to answer those questions for you. And also a quick introduction for our founder and president here, Mike Fleming. Mike's state tax knowledge is very well-rounded. He's one of the United States leading authorities when it comes to e-commerce, nexus, service providers, drop shipping. Over the years, he's assisted thousands of sellers, both foreign and domestic, with their state tax or related needs. Mike, if you want to take it from here, we will go ahead and get started.
Yeah, Ellie, thank you very much for the introduction here. Always a great job. Today is part 2, so we're going to do a very quick review of what we covered yesterday. Then we're going to talk about certificates. We're going to be talking about returns. Registrations is actually a subset of returns. We're going to talk about them in the same category there. And then audits, and then we're going to open it up to questions. So I'm not going to subject you to seeing me the whole time. I find that very distracting. So after this first poll question here, I'm going to turn off the camera and then open it back up at the end. Ellie, why don't we go to that first poll question?
Absolutely, that should be up on your screen right now. Just a quick overview of some things we went over yesterday. So which of the following did we say yesterday? It all starts with nexus. It all starts with taxability. Nexus is all that matters. So we'll leave this open 5 or 10 more seconds. Quick reminder, you do have to answer these poll questions in order to receive CPE credits. If you have any problems answering the poll questions, please send me a direct message. Mike, everyone is getting this one correct. It all starts with nexus. So we'll close this out and move on.
Okay, great. And it does. It all starts with nexus. Because, you know, if you don't have or your clients don't have this linker connection we call nexus with the state can't require you to do anything. Can't require you to pay its income taxes, can't require you to collect its sales taxes. So it all starts with nexus. No nexus, no problems, no responsibility. So that's our first pillar. The second pillar that we talked about was taxability. And taxability can, you know, get very, very granular. For those of you who were here yesterday, you heard my bagel story. The first picture is an unsliced bagel, which is not taxable in New York. The second one is a sliced bagel. No schmear, nothing on that bagel at all. Just when you slice it, it becomes taxable. I was talking to someone else today. I like these, you know, one-off funny taxability stories. You know, one donut in Texas is taxable as a meal ready to eat. But 6 donuts is actually groceries. Now, I don't know who considers donuts groceries, but, or I've eaten 6 donuts at one sitting, so I don't know how they actually come to that, but very, very granular it can get. So what we talked about yesterday is tangible personal property is generally going to be taxable by default, unless there's some sort of exemption, and there's lots of exemptions out there. Services, on the other hand, are usually exempt by default unless they're specifically enumerated or listed by the state as being taxable. So again, every state is different, lots of granularity out there. Taxability, let me back up to Nexus, by the way. I'm starting to see a lot of people come out with Nexus software. And to be real honest with you, you get a lot of false positives with these. I haven't seen one yet that is actually worth doing. You'll end up getting registered in more places than you need to. So Nexus is something I just don't think at this level of technology is something that lends itself very well to software. Taxability, when you're trying to figure out if what you sell is taxable or not, I don't think software is the best solution here either. However, once you figure out what's taxable, I think that software is a great way for you to apply that taxability, especially, if you're doing a bunch of invoices. And, these software companies out there like Avalara and Vertex, they do a great job of staying on top of taxability changes. So this lends itself very well to automation once you figure out upfront if it's taxable or not. All right, so rates, we talked about this. There's roughly 13,500. That's a number we use. Some people use a smaller number. I never heard anyone use less than 7,500. So lots of different rate jurisdictions out there. And this is really something that lends itself well to automation. So if you're just doing 1 or 2 invoices a day, you can do that manually. But the more invoices you do, rates are something that, company like Vertex and Avalara, again, are great doing. Use tax. We talked about this yesterday. You got to worry about, whether you're registering for a seller's use tax, but more importantly, we got to worry about consumer use tax. And consumer use tax, just because you buy something and the vendor doesn't charge you tax doesn't mean it's tax-free. It means you're supposed to self-assess and remit it to the state as a consumer use tax. So this is either the number 1 or number 2 reason, depending on the type of business you have, for large assessments in an audit. So this is something that we need to be taking care of. There are lots of software out there. I'll tell you they can handle this, but this is something, again, that does not lend itself very well to software. You can use software as a tool, but there's generally, you want to take a blended approach. Not all software, not all manual, but doing something in the middle. So this is what we spoke about yesterday. If anyone wants to talk about that in more detail, you can reach out to us. Here's my takeaways. These are the action items that I think we need to do based upon the first 4 pillars. Number 1, you got to determine your Nexus footprint or your client's Nexus footprint. It all starts with Nexus. So that's going to determine what we need to do. If there's no Nexus, we don't have to do any of the rest of the states. So the first thing is determine the Nexus footprint. Number 2 is determine if what you sell is taxable, or determine if what your clients are selling is taxable. Once you determine if it's taxable, you got to have a process for applying that taxability. And that's when I think that these companies, these software companies, play a big role. And then number 3, you have to have a reliable source for rates. Maybe that's rate tables, you know, if you have a legacy system or you've built your own checkout, or, you know, sometimes these software companies, it may be more expensive to build a connector to actually use them than the software itself. So rate tables are sometimes a better solution than automation, but rates are a great way, you know, to implement software. Or to use software to access rates. And then you have to have a use tax accrual process in place. You know, maybe you review all purchase invoices if you don't have too many, or maybe you choose a dollar amount and just review some of them over a certain dollar amount, and then you use a sampling basis for some of these smaller invoices. But those are the action items based upon the first four pillars. And at this point, Ellie, let's go to the second poll question before we roll into exemption certificates.
Yeah, absolutely. Sorry about that. There it goes. Okay, which of the following is not true? So we'll leave this open for you for a few seconds here. And
we'll see how smart everyone is, because
this is a beforehand question.
yeah, this is a beforehand question.
These poll questions are a little out of, I apologize. This is a beforehand question. We'll see where everyone's at the end of this. So Mike, most people are guessing that the nexus of a customer never influences where when tax is charged.
Oh,
so,
very, very smart crew.
Smart crew, we'll see.
Well,
we'll
wait,
get into this section here.
Is not true. So it says never influences. So certificates are not an important issue for pure wholesalers. That's the one that's not true. We never ask our customer if they have nexus or not. I mean, that's not what decides whether we should be charging sales tax or collecting a certificate. It's where the seller has nexus, where that decides whether they need to collect a certificate or not. So that last one is not correct. The correct answer is number 2. Certificates are not an important issue for pure wholesalers. That's the one that's not true.
All right, perfect. Let's go over it now.
All right, so let's talk about exemptions. And once you're registered, you know, you figured out you've had nexus, what you sell is taxable, now you're registered. Once you're registered, you must either collect the sales tax or collect a properly completed certificate in lieu of collecting the sales tax. And it's going to be based upon the delivery state usually, at least when we're talking about tangible personal property. So it's got to be acceptable to the delivery state. So once you're registered, you don't have any options here. You must collect one or the other. And some of the more common exemptions that require documentation. There are exemptions out there that don't require documentation, like if groceries are exempt throughout the state, then no one needs to provide an exemption certificate when they're buying groceries. But these are the most common types of exemptions that require documentation. So, you know, you have resale. If you're buying something for resale, you're going to have to document that. If you're buying something and you're going to be using the manufacturing exemption, you'll have to do that. And if you're a nonprofit, then you're going to have to provide some sort of documentation showing that you're tax exempt. Now, when is an exempt sale not exempt? When it's not properly documented. So if you're the seller and you're collecting certificates, this is a big deal, because if you don't have the right certificate on file, or if the certificate's not completely filled out, then the state's going to kick that in an audit and they're not going to consider it an exempt sale. Now, you can go out and perfect it, but it's harder to perfect things after the fact. So one is an exempt sale, not an exempt sale, when it's not properly documented. So very, very important, because certificates are actually the number one. For companies that have a requirement to collect a certificate, it's the number one reason for large assessments. And it wasn't always that way. This is something that really started changing back, in 2007, 2008, 2009, during the Great Recession. Um, you know, Prior to that, it was really a matter of substance over form. If an auditor knew that this was an exempt transaction, they gave you a whole lot of latitude. And even when companies were being chosen for audit, pure wholesale companies, they just didn't get audited sometimes. A lot of manufacturers who were selling to distributors didn't get audited, because why would the state or why would the auditor want to spend their time where there wasn't a lot of reward, where they couldn't find money for the state? Well, back in the Great Recession, that started to change. The states were really hurting for cash. They had a lot more people requiring a lot more services, and all of their revenues were down. Income tax was down. Sales tax was down. So the states are scratching their heads, said, we can't raise taxes. That'll make things worse. What can we do? And they started saying, okay, let's look at some of the laws we have on the books that we've just not been enforcing. And, certificates was one of those areas. So nowadays, it's a matter of form over substance. In other words, every I has to be dotted. Every T has to be crossed. Otherwise, that certificate's going to be kicked during an audit. Companies that had never been audited before, all of a sudden the state started targeting them. And nowadays, you would think that as the economy got a little bit better, that these states had backed off a little bit. But unfortunately, that's not the case. Nowadays, the states and auditors look at these certificates as low-hanging fruit because, for years, so many companies, they just didn't pay attention like they should have. So this is now missing, incomplete, or invalid certificates. Number one cause for large assessments in companies that are required to collect certificates. And even one missing certificate can have a huge impact. And this is because, audits are usually done on a sample basis now. I'll use an example here. This is an extreme example, but we were involved in an audit, and it was about a $3.5 million audit. Of that $3.5 million, 60% were due to certificates. And in the state of Texas, you have 60 days, to go out and get the certificate. So you get a certificate on day number 61. By statute, the state cannot accept it. The auditor cannot accept it. So you got 60 days. We went out, we found all of these certificates except for one. We also did a great job in the audit. We actually included some refunds within the audit. That's something that you want to try to do because, the interest that you're going to get on a refund is a lot less than the interest you're going to pay on any type of assessment. So anyway, we got this down to about, $15,000, $17,000. I can't remember the exact number, but it was a real low number, except for this one certificate. And we couldn't find it. I mean, we did skip tracing. I mean, the company itself searched their records. It was an individual who had purchased a piece of earth-moving equipment. And they were going to be selling it overseas. And for some reason, the company just didn't get a certificate. And we could not find them. Now, sometimes you can have, that excluded from the sample, but we used up all of our favors here. We went from 3.5 million down to virtually zero, 15,000, 17,000, somewhere in there. So we could not get it excluded from the sample. And this one missing certificate, by the time they took the error percentage and extrapolated it out over the population, $270,000 plus. One missing certificate. Now, yes, the tax on this one certificate was, this one invoice should have been $8,000. And that's bad enough. But that $8,000 turned into $270,000. So when all was said and done, They ended up paying just under 300,000. They were still very happy with us. We got it down from 3.5 million, but that one missing certificate had a huge, huge impact. And, you know, so you may not have $8,000 on any one of your invoices, but then again, you're probably missing more than one certificate or have more than one problem on the certificates that would cause them to be rejected in an audit. And that's why we you know, say that you got to do certificate validation. It's not enough just to collect a certificate. Someone must be reviewing it for the most common reasons it could be kicked during an audit. And, you know, we do a lot of certificate exposure reviews, and, you know, we'll go out and someone says, oh, our certificates are great, and, you know, we don't have any problems. And then we start digging through their certificates, or we do it remotely sometimes, you know, and we ask for, you know, 25 certificates, and 80%, 90% would be kicked for one reason or another. I mean, sometimes they've got sales tax permits in there. Most states do not accept the sales tax permit. So someone's got to be checking these certificates and making sure that they wouldn't be kicked during an audit. Now, here are some of the most common mistakes to avoid. It's not completely filled out. I mean, sometimes the purchases information is missing. Sometimes the seller's information is missing. Sometimes a description of the goods or a description of the business. So every circle there is something that should be checked. Now, this is a Texas resale certificate. You see right on the form there, it says Texas sales and use tax permit number, or the out-of-state number. It's the second circle down on the left. If you put in a Texas number, it must be 11 digits. Now, you don't have to call the state of Texas or get on their website and check to see if it's a valid number, but you do got to make sure that it's 11 digits. If it's 12 digits or 13 digits, the auditor is going to kick it during an audit. If it's 10 digits or 9 digits, the auditor is going to kick it during an audit. So you got to make sure if someone puts a Texas number in there, then it actually is the right number of digits. And a number of other states are like that. Biggest thing though, just make sure that number one, it's on the right form. And number two, that that form is completely filled out. Because when you're accepting certificates, you're accepting them in good faith, which means that if the exemption was not valid, that's on the issuer. And the state can go after the issuer, and there are even criminal penalties as well as civil penalties for the improper use of certificates. However, if you don't use common sense, the good faith exemption may not apply. For example, if you're selling desks and a software company buys one desk from you, does that make sense? No, they're buying that for use in their business. They're not buying one desk when they're selling software for resale. So you could not accept a resale certificate. That's what the common sense test is all about. But provided it does make sense, if it's completely filled out, then you're accepting it in good faith. In other words, the auditor can't come behind and put on their detective's hat and try to figure out why this certificate is not good. But if it gets kicked during an audit, now when you get it and give it back to the auditor, when you perfect it, you know, if there's something wrong with it, now the auditor can put on their detective's hat. They're going to check and see if the company was actually registered at the time they issued this. So you want to make sure that when you're collecting these, there are no problems, that they're not going to be kicked during an audit. So validation, very, very important. All right, drop shipping. This is where certificates, especially, you know, resale certificates, get extremely confusing for a lot of people out there. We have a whole webinar on drop shipping. So if you have questions about drop shipping, I suggest you come to that. But drop shipping is a fulfillment method where the seller doesn't have inventory. You know, they list it for sale, someone buys it, and then they turn around and they purchase that item from a supplier and have it shipped directly to the customer. And this is where, we get a lot of these because the retailer, the person selling this to the consumer, they don't understand that, uh, the ship to address is generally what is going to determine what state's rate that needs to be charged or what state certificate. So a lot of times, they're going to get in a little bit of an argument with you and they're going to say, well, hey, my Texas certificate should work in California. Unfortunately, it doesn't. So we never ask our customers. If I'm the wholesaler or the manufacturer, I don't ask my Texas customer if they have Nexus in California. I'm going to ask them for a California resale certificate because that's the only thing California is going to accept. And if they can't provide that to me, I'm going to charge them the rate, the tax in California, but not on the wholesale price, that we've negotiated, but the price to the customer if known. And if it's not known, then the wholesale price plus 10%. So real important here. Nexus of the customer never determines when or where tax is collected. It's always based upon where the seller has nexus and a responsibility to collect the tax. And this is, a lot of times, that retailer just doesn't understand that a sale for resale is only recognized as a sale for resale if it's properly documented, because they're all upset and they're saying, well, you should, sale for resale is a sale for resale no matter what. You should take my Texas certificate. And unfortunately, that's not the case. So sometimes educating our customers, helping them understand what you can and cannot accept, it takes a lot of the friction out of there. We're asked to step in from both the side of the retailer and the vendor, and mediate disputes lots of times. These are the 10 most difficult states for drop shipping. Illinois is an honorable mention. What I mean by difficult is these 10 states generally will only accept a certificate from that state, and you have to be registered in the state. Now, some of these states, it depends on the actual fact pattern of the transaction and or the seller. For example, in Florida, if the inventory starts inside of Florida, at the time of the transaction, then you've got to be registered in Florida, or you've got to collect a certificate where someone's registered in Florida. But let's say that you have a warehouse in Florida and a warehouse in Georgia, and it's being shipped from Georgia. Technically, any certificate will do because the state of Florida says that that sale is sourced outside of Florida. In that scenario, if companies, a lot of times they don't know where they're going to ship from. If they have a warehouse in Florida or Louisiana, same type of rules. They usually have a policy. We just want the Florida certificate from a registered seller in Florida, or we've got to charge you the tax. So Illinois says that they will accept other documentation, but it is subject to additional verification. And, if you're in the audit, you don't want the auditor looking up all your certificates. So there's a special registration in Illinois. It's called a resale registration. And this way you can get a number, you can put it on the normal certificate, and it doesn't have any other requirements, any strings attached to it. You don't have to worry about collecting tax. So as a best practice, a lot of our clients just suggest that their customers get registered for this resale certificate, because it does, it's a little bit of extra work in the beginning, but, once you're registered, that's great. And, everyone is protected at that point. All right. So here's a little bit of a commercial. This is a chart that we put together. I don't know of any other charts out there like this. It's on the paid portion of our website. We have a lot of free resources out there, and we have a paid portion of the website and lots of information and materials out there, lots of taxability charts. But this is what we call the alternative acceptable documentation. And if a purchaser does not have nexus in a state, there are 36 states where you can provide some sort of alternative documentation without getting registered. So if you have clients who are issuing certificates and are doing drop shipping, this is invaluable. If you have clients or you yourself are the ones collecting certificates, this is invaluable. It'll help you understand where you can stay protected and make life easier for your customers. So let's take a look at some of these. So the third column, delivery state certificates with no nexus statements. So Pennsylvania is a good example of that. And this is New York. So let's go back one. This is the fourth column, delivery state certificates with home state numbers. So New York is a great example of that. And you don't have to be registered in New York to use this resale certificate. You can just go online, download this certificate. You fill out all of the top information. And by the way, you want to make sure it's a blanket certificate. You don't want to have to get a new certificate every time a transaction happens, which is what a single use certificate is. You want to make sure that blanket certificate box is checked. Then you're going to fill out the rest of the information. You go down to part 1, which is in the middle of the page there. And this is for people who are registered in New York, who have nexus in New York and are required to be registered. If you don't have nexus in New York, you skip that part. You go down to part number 2. And you certify that you're not registered and you're not required to be registered in New York. And you are registered to collect tax in the following state or country. So you're going to write in the name of, maybe it's Canada, or maybe it's the UK, or maybe it's the state of Texas. So whatever that is, you're going to put on that first line. And on the second line, you're going to put the actual number in there of where you are registered to collect tax. And then you're going to check box number D. This is an example of the home state number on the delivery state. So New York is where this is being delivered, and the home state number will work on that. So now we're going to look at delivery state certificates with no nexus statements. And Pennsylvania is a great example of that. So again, you're going to want to fill out all of the information in here. Make sure that this is a blanket certificate. It's for multiple transactions. And then you're going to check box number 3. And this says property will be resold under license number. You can put NA in there. You can draw a line through that, or you can put your home state number, whatever you want to do in there. Because in the brackets right next to it, it says if purchaser does not have a Pennsylvania sales tax license number, include a statement under number 7 explaining why a number is not required. So you go down to number 7 and you say, we don't have nexus in Pennsylvania. So this is an example of a no nexus statement. When you're doing a lot of drop shipping, a lot of people want to give you multi-jurisdictional certificates, and there's 2 of them out there. One is through the MTC, and one is through the streamlined sales tax. The one I have up on the screen here is through the streamlined sales tax. This is the one we suggest accepting as a best practice because they're very, very flexible. Once you become a full member of the streamlined sales tax, you have to accept home state numbers. And if you don't have home state numbers, you can put a driver's license in there, or, you know, you can use an FEIN number if there's no tax ID number. So lots of flexibility using this form. Up on number 1, you can, you know, check if you're attaching the multi-state supplemental form. So most of our clients are going to check that, which this is the multi-state supplemental form, and there are 24 states listed on here. In 23 of those states, you can use your home state number. Tennessee is not a full member of the Streamlined Sales Tax Project. They're an associate member still. They've been trying to become a full member for the last, at least 5-6 years at this point. I don't know if it's ever going to happen. Keep getting pushed back 1, 2, 3 years. But in 23 of these states, reason for exemption, resale, identification number, you put your home state number, and then you just draw a line down the page till you get to Tennessee. You skip Tennessee and then draw a line down to the bottom of the page. So this is the preferred certificate. The MTC certificate, you know, there's lots of footnotes on there, but most of those footnotes don't have anything to do whether you can accept a home state number. That certificate is great if all of your customers are actually registered in the state. So, you know, you're only dealing with people, you're not doing drop shipping, you're only dealing with, you know, companies that have brick and mortar locations in a state. That MTC certificate is fine because they're all going to be registered in those states. But if you're doing a lot of drop shipping, unless you're using the chart that we've created here, because it does say which states accept that with a home state number, you got to really know that certificate inside and out. Lots of problems happen with that. All right, so certificate best practices. Number one, you have to have a system. You know, you got to be collecting them. You can't ignore it. Who's going to manage the system? And, you know, this is different. We see, you know, some companies have salespeople, and sometimes that's great. In general, we see the most problems when the salespeople are in charge of collecting the certificates. Some salespeople are very diligent. Others, they just want to get that commission. So we generally suggest using a different department. Some people have the accounting department. Some people have the credit department. You know, some people have the accounts receivable department. So you've got to decide who's going to manage this. Then you got to decide about validation. By the way, there are some great software out there that, you know, can help you store certificates centrally and digitally. And they've got other tools to help you collect certificates, but they can't validate. So even these software companies, they offer validation services. Validation is a service we offer. It's something you can do on your own, but someone's got to be validating it. That part of this process cannot be automated. And Ellie, why don't we go to our next poll question at this point?
Yeah, we're throwing it back here. Quiz you, see what you remember. So if you are not charged tax by the seller, your purchase is tax-free. True or false? We'll leave this open for 10-15 more seconds. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. Mike, most people are answering false. Do you want to touch on this quick and we can move on?
Yeah, that actually is the correct answer. You're supposed to remit the tax as a consumer use tax.
All right, let's close it out and move on.
All right, so let's move on to registrations and sales tax return filing. So we get a lot of questions. When and where should we register? How should we register? Once registered, how often do we file? And what are some common issues? So, you know, our answer is sellers should register whenever there is nexus. Remember, that's the first step. What they sell is taxable. That's the second one. The exposure is material, and a marketplace is not responsible for collecting. So that's when sellers should register. By the way, materiality is my comment, not the states. Most states believe you should be registering from number one. There are some exceptions, like a Tennessee. I think they're at $4,500, but again, that's a very low number. To me, materiality just means we got to use some common sense. I mean, you know, let's say that one of your clients or you have economic nexus, you know, maybe you sold 200, you know, items in a state, but it's a $5 item. That's $1,000. The tax on that is going to be somewhere between $60 and $80. It's going to cost you more, you know, to get registered. Even if you do it yourself, there's an opportunity cost, time, there's time value of money. So you hire someone else to do it, and it's definitely going to be more than $60. Plus, now that you're registered, you've got to, you know, file that return. Again, if the cost of compliance exceeds the back tax plus penalty and interest, does it make sense to file? We say no. Now, just because, you know, it may exceed the cost to file Does that mean you got to run out and get registered? Most of our clients don't. They're going to determine what's material for them. And they're going to take these three factors into consideration when they're making that decision. I mean, we have some people who call us up and say, Mike, I can't sleep at night. This has got me worried to death. Well, if that's you, then, you want to have a very low personal threshold. If you tell me that you go into Vegas every weekend, you never lose, that nothing bad has ever happened to you in your life, and you don't think a state's going to find you, well, maybe your threshold's going to be a little bit higher. So most of our clients decide to register somewhere in that $10,000 range. But that can be impacted by profit margins. I mean, if you've got really low profit margins, we speak to some clients who, we're trying to build market share. So we're working at razor thin margins, 2%. Well, if the average sales tax rate is 8% and you're only making 2%, add, approximately 50% for penalty and interest on top of that, you're looking at, an effective, exposure rate of 12%. If a state finds you 2, 3, 4 years down the road, not have you only wiped out your profits in one state, you may have just put yourself out of business. So the lower your profit margins, the lower your personal threshold should be. And then capital reserves. So most people that we work with are plowing everything right back into the business or taking it out for fun or to live on. Some of the companies that we work with, have capital reserves, and they're going to have a little bit higher personal thresholds. But these are the three things that you want to look at when deciding what's material to you. People always ask me, Mike, you tell me what's material. Well, I can't do that. I mean, let's look at Coca-Cola. $100,000 to Coca-Cola is like a rounding error. To me, $100,000 is a lot of money. And to each client that we work with, there's everything in between. So what's, material to one may not be material to the next. All right, so ways to register. You can register prospectively, and that simply means that we're going to register going forward and only worry about collecting tax going forward. You can register historically, which means that you're going to use the date that your nexus actually began. This is what states want you to do. Or you can register through a voluntary disclosure agreement. In a voluntary disclosure agreement, generally it's going to be 3 or 4 years, and you would do that to mitigate your past exposure. If a state finds you, they're going to come back either 7, 8, or 10 years, depending on the state. They're going to want all the back taxes, penalty, and interest for their period. They can be ruthless. So if you step forward voluntarily, they're going to limit that look back period to either 3 or 4 years generally. And they're going to waive the penalty. And in some states like Texas, they may even waive the interest. Not a lot of states do that. There's less than 7 states that waive some or all of the interest. But these are the ways that you want to look at registering. Once you do register, filing frequencies play a big part here, especially when you're doing returns. And we'll talk about that in a second. But very few states allow you to choose your own filing frequency. We have people call us up all the time and say, hey, we want all annual filing frequencies. Great. A lot of people would. But it doesn't work that way. Now, some states are going to set your frequency by statute. In other words, Georgia, they say that for the first 6 months, you're going to be monthly no matter what. And then we'll look at it after that. Some states are going to do it by estimated sales. So, whatever your sales are, they're going to base your filing frequency on that. Now, most states, after a certain period of time, they're going to review your frequencies and change them. So this happens a lot, at the end of the calendar year. And it's important who's doing your returns, because if they're not paying attention to this, they don't catch it. All of a sudden, you go 1 or 2 or 3 periods, and now you got a problem. Now you got all sorts of penalty and interest issues. So most filing frequencies are going to be either monthly or quarterly. They can be semi-annual or annual, but a lot of states say if you're remitting less than $80 of tax a year, or 86 or, really low numbers, then you can be an annual filer. To me, I look at that and say, that's not very material. What do we even want to register for? Now, there could be reasons, maybe you need exemption certificates, but that's a whole nother conversation. All right, so sales tax return filings. A lot of people out there say they have auto file. Most states, there's no auto file. There's someone behind the scenes who's actually filling out your return and remitting it to the states. So, this is not something that's automated. I mean, a software company may do it for you, but it's definitely not automated. You can do it yourself. You can hire a third party, sales tax specialist, someone like us. You can, work with your existing accountant or bookkeeper or software companies. When you're working with software companies, you got to be careful. There are full service software companies, like an Avalara or a Vertex. And then there are limited service software companies like a TaxJar. And, when I say full service or limited service, Avalara can file pretty much any return you need filed. Whereas a TaxJar, they generally can't do use tax returns. So, I mentioned yesterday, they'll call you up and say, hey, we can't file a use tax return, so just switch this over to sales tax, which has a big, difference. There's a lot more issues you got to worry about when you get registered for sales tax. So make sure the capabilities of the software company you're working with. And for most people, any companies of any size, if you choose to do a software company, then you want to do one that offers a full service. All right, so points to consider. How much time do you have to devote? Can the provider file all the returns you need? Who's going to be your point of contact? I mean, software companies are, like Avalara are great. They can do everything, but you're just a number. They're filing so many returns. You're never going to talk to the person who actually does your returns. You're going to be talking to some mid-level customer service person. So who's your point of contact? Does your provider know the red flags and how to avoid them? This is very important. If you're registered to collect sales tax, one of the ways you get chosen for audit are these red flags. So let's take a look at them. A pattern of filing returns late, a pattern of filing substantial amounts of exempt sales, returns not balancing to what the state expects. That's really, really important. So, is the company just remitting what you submitted to them, or are they actually massaging it so it looks like what the state's expecting? So incorrect forms, incorrect rates, incorrect application of credits, forms completed incorrectly. So the incorrect forms is a big one here. I mean, if you're registered for the local taxes, you want to make sure that, the person doing your returns can do local taxes. Some of these software companies just can't do them. Again, Avalara, Vertex, quality companies, they can do it. Some of the lower tier software companies can't do it. All right, so let's look at sales tax audits. So there's no way to ensure that you'll never be audited. However, you can have some great policies in place to avoid large assessments in an audit. You can also work on limiting the red flags that may increase your risk of audit. So the policies that we're talking about, you got to take care of the first 6 pillars. So if you know your nexus footprint and register when appropriate, if you know what you sell is taxable. By the way, when you have any doubts, tax planning, the most conservative route to take is to tax. You got to source your sales correctly, charge the best rate that you can. It's not always going to be perfect. You got to have a use tax system in place. You got to collect, validate, and update your certificates on all exempt sales. We generally suggest, even on the ones that don't expire, updating every 3 or 4 years, because a lot can change in 3 or 4 years. And it may have been valid when you accepted it, but something may have happened and it's now expired. And make sure your returns balance. If an auditor comes in, they're going to ask to see your IRS tax returns sometimes. So your sales, got to pretty much match your federal returns. It's got to, have the numbers that the states are expecting. All taxes remitted. I mean, we get calls, sometimes 6 months, 9 months after someone starts working with one of the lower tier software companies and say, hey, I just found out they're not remitting all my tax. I got a bunch of tax collected and not remitted, and it's sitting on my, in my accounts here. So I got to do something about that. So make sure all taxes are remitted and make sure you're limiting your red flags. All right. So how are registered companies chosen for audit? Most of them, it's a lottery, small to mid-sized companies. Sometimes it's a red flag. Asking for a refund. Now, we've got to ask for refunds sometimes, but that is often a reason for a state to audit you. Industry issues. I mean, if I used this example yesterday, but if someone, says, well, everyone in the industry does it this way, then the state knows that the industry has issues, and all of a sudden they'll start auditing everybody in the industry. So playing the follow the leader, doing what your competitors are doing is not the correct way to form a sales tax strategy. And then informants, a lot of states, pay bounties out there. So maybe your employees telling you, maybe your competitors, maybe your customers. So these are ways that registered companies are found. Initial steps to take when notified of an audit, you got to review your pillars. If issues are found, you can, number one, consider a managed audit. If you have some glaring problems, a managed audit is when you hire someone like us to do the audit for you. And as a reward, the state will generally either limit or waive penalty and interest. So if you know that there's going to be a big issue here, then you might want to consider a managed audit. Before the audit starts, as soon as you get notified, work to correct certificate issues. You're going to want to reach out to your customers if there's something missing or not valid. You can have someone like us step in and do an exposure review. I mean, we can examine your certificates and say, these should pass or these shouldn't pass. Request missing records from customers or vendors, and look for offsets. Are there any refunds out there that you might be able to request and put them inside the audit? Now, this is not always going to work. Some states will not let you put refunds inside the audit. Some states don't offer managed audits. So these are general steps. They're not state-specific steps. And you got to always review what the auditor is requesting. Is it reasonable? And there are some things that you should wait until after the fact, but you want to work with the auditor for the most part, because auditors have a lot of influence concerning your company. And while you don't need to be best friends with an auditor, we strongly suggest you try to have a good working relationship. You don't want to alienate your auditor, because the auditor is always going to have the last laugh. I mean, I can't tell you how many times people brag about, in the winter, putting someone in a room with no heat and trying to freeze them out, or in the summer, putting them, in Texas, putting them out in a shed with no air conditioning, thinking that the auditor is going to leave quickly. Well, yeah, the auditor may leave quickly, but they're going to set you up for all sorts of things that if you had treated that auditor well, you could have avoided. So here's some best practices. Set one contact person. You want to have message consistency. This contact person should have a knowledge of your business. They should have access to records, knowledge of tax policy. Don't assume the auditor is your buddy. You want to be friendly, but you can't assume they're your buddy. You don't want to have too much idle chit chat and inadvertently disclose something that you don't want to, the auditor to know about. Answer questions, but don't volunteer information. You want to work with the auditor to keep items off the schedule. It's a lot easier to keep them off the schedule than to try to get them off the schedule later on. Don't assume the auditor is right or wrong. Don't be afraid to question the auditor. Ask for documentation of items you don't agree with, and don't be afraid to ask for the supervisor. Now, while you're doing all of this, you got to take out all of the passion. You got to take out all of the personality. I mean, if you're arguing on a point because you think this is the way that it should be, that's not going to get you anywhere. You've got to base all your arguments in fact, and the way that you're interpreting things. You'll get a lot more from that. Now, after the audit, have an exit conference with the auditor, review your assessment. Is it fair? Are there any factual errors? Is it worth appealing? Sometimes, it's just better to accept it and pay it. You can ask for a payment plan, ask for a penalty waiver. You correct any deficiencies so you don't have the same problems going forward, or in other states. And but I see so many companies that get, make this personal, and they just want to fight it. And sometimes they're throwing good money after bad because their arguments are not based on any of the statutes. It's just, well, I feel this is the way it should be. And that's never going to win. So I shouldn't say never. Never say never. Generally not going to win you any appeals. All right. At this point, Ellie, let's open it up to questions. We got any good ones?
Absolutely. So we'll just jump right in here. So we deal with several mom and pop stores. We use Avalara and send a letter with a certificate request. Many still do not fill out the certificate correctly. Any other thoughts to educate the customer on how to complete the certificate?
Yeah, the having someone at your firm who understands all of the options and what can and cannot be accepted is paramount. Sometimes there are certain parts of the certificate that you can pre-fill out for them. You never want to fill out the reason for the purchase. That could make you lose your good faith exemption. But, if they're leaving off your information or something like that, a lot of our clients just go ahead and fill that in for them, help them out as best they can. You can use tools like Avalara has some great tools to do that, but sometimes it takes a call to the client and walking them through it. Things like that can be outsourced. And I know Avalara offers services not only for validation, but for hand-holding on certain problematic clients, and we do the same thing.
All right, thank you, Mike. And let's do just another question here quick. So what's going on with Missouri? Should we require a customer to register to drop ship into Missouri for them?
Don't really understand the question. We need a little bit more information there. Not understand what you mean by what's going on with Missouri. In general, all states require you to collect a certificate. Missouri is not one of the 10 tough states, so it is a state that allows acceptable alternative documentation. So I'm not sure where you're coming from with the question.
Yeah, so if you want to go ahead and send us a quick email, or, Mike, we had a quick follow-up here. Do you want to address this later? Do you want to try to address it now?
Let's try to address it now. I may know the answer. I may have to look into it.
All right, perfect. So the follow-up is, are we allowed to drop ship into Missouri without them registering? We have been told they have special drop shipping rules.
Yeah, and there's all sorts of alternative documentation. Missouri is not one of the 10 tough states that I mentioned earlier. When you get to slide deck, you'll see that, and I don't know if you'll be able to see it on that chart. But this is precisely one of the reasons why that chart is so invaluable. It'll tell you exactly what you can and cannot accept, if you're registered or not. So I'm assuming you're the retailer. If you're the retailer, then There's specific documentation that you can issue so that your vendor doesn't have to charge you the sales tax. If you're the vendor, you know, you got to worry about economic nexus. Are you over the, well, Missouri doesn't have the economic nexus yet. Looks like it's going to be later this year. Looks like it's going to be $100,000. It looks like no transactions at this point, and it looks like it'll become effective on October 1st. But if you're over that, or if you have a physical presence in Missouri, then you got to be registered there. So every state has different rules when it comes to drop shipping. So again, if this is something you want to talk about in more detail, and let me know the specifics, you know, in sales tax, so often the answer is going to be, it depends. And it depends on the specific set of facts and circumstances that surround the issue. So sometimes you just can't give a blanket answer, but yeah, there's alternative documentation that can be used in the state of Missouri.
Thank you so much, Mike, and thank you everyone for attending today. We really appreciate your presence. We hope that you join us for future webinars. Really encourage you guys to check out the premium portion of our website. We have a lot of good feedback. There's a lot of resources there. Also check out our podcast, and you know, like I said, join us for our free future webinars as well. So Mike, did you have anything else you wanted to add in here?
No, just about the workshops, which we're rolling out at the end of this month. The first one is how to do a nexus review, both economic and physical nexus. So that's the first workshop. These workshops will be 2 hours long, and they're good for 2 CPE credits. We'll go into a lot of detail. We'll provide you all the tools that we use to conduct nexus reviews. And as a matter of fact, we'll be using the data from people who are attending. So if you want us to look at one of your clients, or if you want us to look at your information, we can use that as an example. Of course, all information will be blacked out. We won't share that, but we'll do the nexus review live using the information provided. So that will be the first one we're going to offer. We're not offering any in March, but then we'll be doing 12 throughout the rest of the year. So that'll be 24 credits. If you don't want to become a member of the premium portion of the website, they're free. If you are a member, if not, they're $200 a piece. So other than that, we want to appreciate everyone for showing up. Give us some brutally honest feedback. That's how we get better. And if you have some suggestions for the free webinars, please let us know. We'll try to accommodate you whenever possible.
Yeah, thank you. Thank you, everyone. Have a wonderful afternoon, and thanks again, Mike.
Thank you, everyone. Bye-bye.